Your LinkedIn feed can give you daily insights from your professional community. It cannot keep you updated on the daily office gossip.
Oh my gosh, no way.
It can help you stay informed on the latest news and trends in your industry. It cannot stop your boss from trying to start a new office trend. Who's ready for Flip-Flop Fridays? And while we can't stop all of the office jargon,
Does this vibe with our collaborative lattice work metric?
LinkedIn can start taking your career to new heights. LinkedIn is the network that works for you.
Study
and play come together on a Windows 11 PC.
And for a limited time, college students get
The best of both worlds.
Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. Last week in the stock market, we had a relatively mixed week with all of the three indexes. The Dow Jones was the winner. It was up 0.6% for the week. But was it really the winner? We're going to talk about that on this week's episode of Investies. The S&P 500 was down 2%, and the NASDAQ was down 4.6%. That is a relatively steep loss for the week. We have been facing tech sell-offs for almost 2 years regarding the same concerns, which are capital expenditures and, of course, the spend on the data centers, the controversy that the data centers are bringing into every single state where they are being built, the lack of transparency regarding the actual amount of resources that are being used or will be used by the data centers, and the impact that that will have on every state where they are being built. There is a lot of pushback from citizens, and rightfully so, especially with the lack of communication from the actual data centers to the citizens, the transparency from the government to the citizens. It makes sense on the pushback, but also makes for, I don't want to call it a dangerous investment. I guess I would say a risky investment from AI companies or tech companies into this specific part of the industry within their sector. Along with the ongoing fears pertaining to CapEx and data centers, we did have a sell-off specifically pertaining to the chip industry within the tech sector. This is because there was a report that OpenAI was thinking about delaying their IPO based on SpaceX quote-unquote rough debut. SpaceX is actually being called a flop. It was up 31% from the IPO open and is now down almost 6% from its opening day and 28% down from its all-time high. Now, you cannot say that you were not warned if you listen to Investies podcast. Shifting over to this week's topic of Investies, as of this morning, Google, or I should say Alphabet, the parent company of Google, has now joined the Dow. The Dow has kicked out Verizon after 22 years to make space for the tech company Alphabet. And it feels really late in the game, honestly. You know what this reminds me of? It brings up a very specific memory I have. 2019 Berkshire Hathaway investor meeting, when Charlie Munger says in reference to investing in technology, I don't mind not having caught Amazon early, but Google was different. Munger goes on to say that he felt like a horse's ass for not identifying Google better. We screwed up, he says. And then Warren Buffett steps in, as he normally does, to speak for or on behalf of Munger and says, he's saying we blew it. Munger steps back in and says, we are ashamed. We atone. We're trying to atone. Maybe Apple was the atonement. Munger is specifically talking about 2016 when Berkshire Hathaway made a really famous investment and started deploying money into tech, Apple specifically, but also made it very clear that this was not the decision of Munger or Buffett to make this investment. It was someone else that was on their team, cannot remember the names, but they made it clear that it was not them. And so, Berkshire Hathaway has been a little late, but their investment style is completely different. Obviously, as an investor, I have tremendous respect for Warren Buffett, all of the donations that he's made, his ability to live in the same exact house that he bought when he got married to his wife. I mean, his trajectory has been incredible. You cannot be an investor and not have some sort of admiration for what Warren Buffett has built. However, he is a value investor, very different type of investor than the way that I like to invest. I do believe it is extremely outdated, especially in a world where we are so dependent on technology. And the Dow just really gives Warren Buffett vibes. And that's what I want to talk about today. We continuously hear about the Dow. It is headline news and it can be misleading. I talk about the Dow every single week. I report on how the Dow performed. If you have heard me throughout the years, I have talked about how very little the Dow's movement should have impact on the way we look at the market. We should be much more dependent on the S&P 500 as a true indicator on how the market is performing overall. The Dow only holds 30 companies. To help put this into perspective, the NASDAQ holds 4,000. And of course, we know the S&P 500 has the amount that it holds in its name, 500 publicly traded companies. What a lot of people do not know is that the Dow is built on a math quirk from 1896, okay? It is built on a concept from 1896, before cars, before airplanes, and until this morning, it didn't even hold Google as a company. So take that into consideration. Today is Monday, June 29th. We're recording this episode in the morning. Even though I myself quote the Dow, and honestly, it is more out of some weird Wall Street respect that I have for the Dow itself. It's just like this dinosaur that I have to mention to pay it its respect. But the idea that we write headlines over this, the idea that Trump will hold a press conference over how the Dow performed it's nothing, and it's important, I think, that we know. And I also kind of feel like the news about it finally adopting Google tells us how outdated this index is, and that we really shouldn't place any weight, no pun intended, on it at all. For our newer listeners, an index is just a scoreboard. It takes a basket of companies and boils them down to one number so you can see it at a glance and understand whether the market was positive or negative and how it performed over the course of the day, a week, a month, a year, a decade. And it sort of helps us calculate on our personal success pertaining to the growth of our individual portfolios, and also, in some cases, the success of the country, or at least the success of those that are actually investing, and not just helping prop up the market by sole consumption. which clearly was the intention of how the market was constructed. The idea that there would be mass consumption and only a few amount of people actually win from that mass consumption, which is why Investies is trying to disseminate this information so that more people can not just be consumers, but also investors. A great way to think of an index is like the GPA on your report card. It is basically summing up your overall performance. You cannot buy the index directly. Like you cannot buy the Dow, you cannot buy the NASDAQ, you cannot buy the S&P 500 directly. But what you can do is buy a basket of stocks that copies that specific index. So it's continuously moving. As of this morning, along with the Dow adopting Google now in their portfolio, there were hundreds of funds that did the same thing. They also sold off all of their Verizon and purchased in its place a lot of Google stock, which then gives everyone who purchases that specific fund exposure on how the Dow looks up to date. A quick point of clarification here for our newer listeners. An exchange known as the NASDAQ exchange or the New York Stock Exchange is not an index. It can get confusing because we hear the NASDAQ exchange, which is also an index. When you hear the word exchange, I want you to think of like a supermarket. So think Kroger, Aldi, different variations of different supermarkets. That is the closest analogy I can think of to what the NASDAQ as an exchange is, the New York Stock Exchange, which are the two big ones. You also have the Chicago Exchange, and soon, as you already know, we will have the Texas Stock Exchange.
Growing a successful business has never been easy. But whether you're navigating a complex industry or trying to reinvent one, our breadth of banking experts are here to collaborate on market-proven solutions. At KeyBank, we're built to grow with your changing needs because we're not just here for the business you are now, we're here for the business you'll become. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms loaded with features that let you dive deeper into the market. Visualize your trades in a new light on Thinkorswim desktop with robust charting and analysis tools, all while you uncover new opportunities with up-to-the-minute market news and insights. Thinkorswim is available on desktop, web, and mobile to meet you where you are. It's built by the trading obsessed to help you trade brilliantly. Learn more at schwab.com/trading.
We're going to get into how the scoreboard or how the GPA does its math. How do they calculate these numbers, and why is the Dow so late in holding some of the most biggest and most impactful companies in the country and the world? Not all of the indexes are calculated the same. We have briefly talked about this here on Investies podcast throughout the years, especially when the Dow is centered or highlighted. The Dow is price weighted, which is not the same as how the S&P and the NASDAQ are calculated. Price weighted means that the company with the highest stock price is the one that pushes the Dow around. It's the one that is currently controlling the Dow. And while that might seem logical, just if you think about it, like, of course, the stock price that is the highest should be the one that is impacting the company the most. But remember when we covered SpaceX IPO and we talked about the float, there is a number of shares that are out for distribution in the public. When a publicly traded company does a stock split, that means that there are more shares that are duplicated multiple times depending depending on however big the stock split is for the specific company that is holding the stock split, that changes the price. It doesn't necessarily mean that the publicly traded company with the highest price tag on its shares is the most successful or the biggest. It is all dependent on how many shares are open to the public, made accessible for us to buy, and the demand. Remember, it is the demand that is pushing the stock price higher. An example would be a company that has a share price of $600. That would move the Dow 10 times more than a company that had a share price of $60. Even if the $60 company is actually, let's say, 5 times bigger than the one that has a $600 share price. This is also confusing for a lot of normal folks that don't necessarily understand the way the stock market works. It's misleading. You may think that it is more valuable because of the share price. The share price has zero to do with how successful the company is. We learned that in the SpaceX IPO. We learned that when we understand that companies aren't necessarily profitable, but their share price is still very expensive. The S&P 500 is market cap weighted or market capitalization weighted, not price weighted like the Dow. Market capitalization or market cap is the company's total value. And the way we do that math is the share price multiplied by the number of shares that are accessible to retail investors like us. So a $100 stock price with 1 billion shares accessible is a $100 billion company. Please note here as well that the market capitalization also has nothing to do with the fundamentals of a publicly traded company. It does not reflect the revenue. It does not reflect the profits. I want to make sure that we are really clear on this. Fundamentals is what the business actually does. This is revenue, profit, cash flow, debt, margins. Market capitalization is what the crowd, what us, institutional investors, retail investors are willing to pay for the company right now, in this moment. It is the share price multiplied by the number of shares. The share price, this is just the sticker on a single share. This is the sticker price. This is how much does the share currently cost. A really important caveat to all of this so that you all don't just freak out and think that the market capitalization is some random number. Even though it is not directly tied to fundamentals, it does for the most part reflect it. Let me explain. Institutional investors and retail investors, for the most part, are attracted to companies that do have strong fundamentals. This is why, as investors, it is very important for us to listen to quarterly earnings calls pertaining to the companies that we are invested in or companies that we are interested in potentially investing into. This is what attracts us. So while the actual market capitalization or the calculation of the market capitalization doesn't necessarily pull from fundamentals, it does show a reflection of a group of people that are interested in fundamentals. This is why there is also current fear in the market. In order to put all of this into perspective, we have what is called the PE ratio. The PE ratio will tell us how much we are paying for a stock that may potentially not reflect fundamentals. I'm not going to get into PE ratios on this episode. I do talk about it in my course and also in my book. I just really want us to get clear and understand that market capitalization isn't necessarily a direct calculation that has to do with fundamentals, but it does kind of reflect it because, again, the people that are making the decisions to invest in this company, hopefully for the most part, are paying attention to earnings calls and the actual fundamentals themselves. This is why it is so important for us to have analysts to hold the line, hold publicly traded companies accountable. We talked about this several episodes back on what a publicly traded company says they are going to do. This is why a miss or a beat on earnings calls is important, because they are also analyzing the performance of the company and we are measuring them by an expected performance. And so if they miss expectations, most of the time you will see a stock get punished and the share price drop because people are selling out of that specific stock. So while it doesn't necessarily reflect fundamentals in the calculation of market cap, it does overall tell a story, and all of those pieces, all of those parts of the story are in fact connected. The NASDAQ is also a market capitalization weighted index. The only difference between the S&P 500 and the NASDAQ composite is that this index only has, for the most part, tech stocks. So it lives and it dies by how tech is performing. You can start to see why the Dow was up last week, or at least why it's different from what took place with the S&P 500 and the NASDAQ. And of course, we can also see the NASDAQ got hammered by 4.6%. Why that is also so different from the S&P 500, because it holds all of the, for the most part, tech companies. And as we discussed at the beginning of this episode, the tech companies are currently getting punished for some of the doubts on the valuations, some of the concerns on capital expenditures, and the data centers. Here are some of the reasons why I think we should completely dismantle the Dow Jones and not give it so much importance. I do realize that I am part of the problem, and I think it's time to completely do away with the press conferences and the headlines pertaining to how the Dow Jones is performing. Typically, when the S&P 500 is down and the NASDAQ is down, it doesn't matter because the Dow Jones hit a new all-time high and there's this press conference that is held. And really, it's not telling us the entire performance of the market, and we treat it as a highlight reel. Reason number one, it only holds 30 companies out of the more than 5,000 US publicly traded companies. We are measuring the market by 30 companies, and as we were reminded this morning, Google is barely entering the chat. Reason number three, a committee picks the members by hand. So unlike the S&P 500 rules-based system, a committee of people from S&P Global and the Wall Street Journal literally sit in a room and decide who is in and who's out. This is subjective. Although I will say that I feel like this reason really doesn't hold any weight, given that we just changed the rules to how companies enter the NASDAQ based on SpaceX, allegedly. Reason number four, it is slow to change. The Dow has historically clung to old economy names, and it has been late to add the tech giants that are truly impacting our lives every day. I mean, how often are we not Googling things? And actually, you know what? We're not even Googling things as often as we used to be. It's bringing in Alphabet when Alphabet is almost outdated. People are now AIing everything. They're asking Claude, they're asking ChatGPT, and we're barely ushering Alphabet into the Dow. It feels like Alphabet is on its way out. Also, public service announcement from your investee. Please don't Google stuff on ChatGPT or Claude. Don't do that. That is not how you are supposed to use AI. Google on Google what you need to Google. ChatGPT and Claude and all of the other AI applications should be used in a completely different way. And my last and final reason is how the Dow is actually calculated. When the Dow was first created back in 1896, this made sense. It was just an average. Let's say that the Dow only had 3 companies. One company was priced at $100, another one at $200, and another one at $300. You would simply add all of those share prices up for a total of $600. Divide that by 3, the number of companies that we're measuring, and then you would just simply get the average of $200. That was it. It was the average. Because of all of the stock splits that we have now, or the reverse stock splits, they impact the share price, and they don't impact the share price in a way that would accurately read the Dow or the intent of the Dow. So now there's this whole other complicated way of calculating the Dow. And instead of dividing it by the number of companies that are in the Dow, you divide it by 0.147. That's as of today. That number is currently changing all the time. I'm not going to get into that because I really don't care to get into that. I think it needs to be completely removed from the way we even measure the market overall. So no need for any of us to retain that number. Just know that the calculation is currently crazy and changes all the time. And to me, it makes absolutely no sense. And maybe there's someone out there that can defend it. Other than it being this formality of highlighting the Dow, I don't see any other purpose for it. It's more like a mascot than it is an actual measurement. So the next time that I am highlighting that the Dow reached some new all-time high, or that anyone else is highlighting that, please know that it's just a number that really doesn't reflect the market anymore. Thank you for listening to this week's episode of Investies. I'm your host, Linda Garcia. A very special thank you to the team, Crystal Patino, Asia Simpson, Eliza Smith, and Jacob Winnick. Everything you hear on Investies is for informational and educational purposes only. Nothing on this show is financial advice. Nothing should be taken as a recommendation to buy or sell any investment. Always do your own research. I am not a financial advisor.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.